Good morning, and thanks for joining me for today's FS Club update on EU financial services legislation and associated initiatives. We kicked off our first webinar of the year back in January with Dr. David Doyle, providing us with his hotly anticipated update on the EU financial services regulatory agenda. So as we reach the end of the 6 months, it's timely to chat with Dr. Doyle again and find out how regulatory developments in the financial services space are working in practice. I'm particularly intrigued to get David's insights into the creation of the EU AML Authority, which oversees high-risk entities, and revisions to the EU Payments Services Directive, the Digital Operational Resilience Act, and the recently announced EC Retail Investment Package. David is known across Europe as a leading expert on EU financial services regulation. A former diplomat with over 20 years' experience in mainland Europe, David now acts as an EU policy advisor. He is a board member and secretary to the Financial Services Working Party of the Joint MEP EU Industry Advocacy Body at the European Parliament, and holds a seat on the board of directors at the Genesis Initiative at Westminster that promotes entrepreneurship and SME policy. Now, before I hand over to David, the usual brief housekeeping points from me. If we haven't met yet virtually or in person, I'm Charlotte Brashley and I manage the FS Club here at CN. I'd like to warmly acknowledge our very generous sponsors who enable us to continue to bring you a wide-ranging, thought-provoking content across finance, technology and economics. And as usual, the slides are publicly available on our website and in the chat box. We'll record the session and it will be available to watch on our website within 48 hours. And as usual, the Q&A session will be for about 20 minutes after David's presentation. So please use the GoToWebinar chat facility to send your questions in to me early, and then I'll feed them into the conversation. Now, without further ado, it's my pleasure to hand over you to David. Thank you.
Thank you, Charlotte, and welcome, ladies and gentlemen. Well, I start this session with some reassuringly good news, at least for those of us who still harbour ambitions to restore unfettered access for financial services in these islands towards the single market. This week, on the 27th of June, the United Kingdom and the EU signed the long-delayed post-Brexit Cooperation Pact on Financial Services, better known as the Memorandum of Understanding on Regulatory Cooperation, which was part of the UK's deal in exiting the European Union, but was put on ice because of clashes with Brussels over trading arrangements in Northern Ireland, which has now happily since been resolved through the Windsor Agreement. So the first meeting foreseen under this Memorandum of Understanding between the UK and the EU authorities is due sometime this autumn, allowing both sides to have a very collegial exchange of views about regulatory changes, international developments, risks to markets, and the avoidance of any regulatory arbitrage. So an important turning point. A key point of this memorandum was indeed the setting up of this forum, which would meet, I think, at least twice a year, as it does, by the way, with the US and the EU authorities. The deal, which went into only 4 pages in terms of the Memorandum of Understanding, does pledge both sides to work together in terms of rulemaking, which I have to confess remains rather thin on the ground insofar as the controversial equivalency arrangements are concerned. There is still a concern, a lingering concern, that for any banks of a non-EU nature, EU member nature, they still need to set up a branch or a subsidiary going forward. And under MiFID, of course, there are further restrictions. Now, the other good bit of news was actually yesterday. At the closing of the trilogue discussions surrounding the third version of EMIR, the clearing of derivatives, the rapporteur, Polish Professor Hubner, agreed to relaxing the rules in terms of access by EU counterparties to clearing euro-denominated derivatives in the City of London. It was formally seen that the UK clearinghouses, or indeed all clearinghouses based outside of the EU, would have to set up an active account in some of the EU member states in order to be able to clear derivatives going forward. This has now been put back. The focus of the EMIR 3 orthodoxy now going forward in its final stages is to allow a little bit more time for all parties to continue to do two things. One, to be able to allow EU counterparties to clear in the City of London, even beyond the end of June 2025, but at the same time, helping and assisting and facilitating the creation of European Union CCPs with the necessary liquidity, institutional capacity, and also expanding the list of products that can be cleared through derivatives. So I think in general, pretty good news. I mean, it has to be said that the UK and the EU do have a pretty strong foothold and footprint in terms of financial services exchanges. When you think about it, London represents 84% of all derivatives trading, over 90% of all derivatives clearing in euro-denominated derivatives. The bulk of the 90 trillion euro derivatives market is largely cleared through London. 82% of all FX trades and 42% of all assets under management. So you can understand why both sides see the virtues in coming together, signing the memorandum of understanding, and embarking on this hopefully constructive dialogue going forward. The challenge, of course, for the EU is that the EU, since 2006, has seen its share of global financial transactions actually decline from something like 30% to 13% of global financial transactions, whereas Asia now represents 40% of the global financial transactions are currently undertaken, and it's growing much, much more quickly. For the non-EU member states, clearly the key issue going forward will be the equivalency arrangements that allow, notably the UK banks, investment firms, access to the single market going forward. But having said that, there are a number of other parallel activities and pieces of legislation going through the EU at the moment. Most of these have already been approved. Most have implications, some good, some bad, in relation to access by non-EU member states. Take an example, of course, being the DORA piece of legislation, which is now being finalized. It will be coming into place in 2026. But what this is doing, it's incorporating a massive vulnerability factor that was recognized by the ECB, by ESMA, by the FSB going back to 2008 of the financial crisis, that too many banks and investment firms, pension funds, insurers, reinsurers were outsourcing massively their ICT activities to third-party ICT providers, in some cases not actually based in the same country, and accentuating the vulnerability factor, of course, was that many of these third-party ICT providers were based in non-EU member states. So this piece of legislation is an all-encompassing, probably one of the very, very few regions in the world that has such a comprehensive, as it were, piece of legislation. Even in the United States, they aren't quite there yet. And when one thinks about last week, the largest US public pension fund, CalPERS, reported a cyber attack which affected 770,000 of their members due to a global data breach. The reason being was the subcontracting of ICT services to a third-party provider. So we're reminded just how important this is in the European context when we see some of the magnitude of this piece of legislation. So quite clearly, a core piece of this legislation is incorporating the critical third-party as ICT providers. Now, critical, what does critical mean? We still have to define this. This is one of the regulatory technical standards that's being developed as we speak by ESMA. But a preliminary definition of this would seem to be any third-party ICT provider that works with a single, and notably a single, global bank or a particularly large, systemically important investment firm that provides services of an ICT nature across at least 6 EU member states. That it becomes a critical ICT third-party provider, which requires much more due diligence to be undertaken. This, by the way, also includes cloud services, which are a huge outsourced activity in the case of banks and insurance companies. So this will cover a huge, as it were, eventail of financial service entities, ranging from banks that we've already mentioned, e-money, and payment institutions, except payment institutions that are already exempted under the PSD version 2, and no doubt this will be carried forward into the Payment Services Directive version 3, which is being finalized. But it includes crypto asset service providers and issuers, CCPs, trading venues, data reporting services, trade repositories, AIFMDs, management, US UCITS companies, insurers, intermediaries, credit rating agencies, and investment firms. So a huge scope, nobody's left out. What this requires of financial institutions, as distinct from the third-party, as it were, outsourced providers, is that banks and insurers and pension funds will have to have well-documented ICT management frameworks, policies, procedures, protocols, which will be investigated and examined by national regulators. Indeed, clearly, it's the national competent regulators in each member state who will have the oversight, the primary oversight of the overseeing this piece of legislation and its proper application. The other area is reporting on any major ICT-related incidents and immediately notifying the National Competent Authority, which hasn't always been the case in the past, reporting on any major significant cyber threats, also with immediate effect to the national competent authorities, reporting on any major operational or security payment-related incidents, with payments being a real focus of this piece of legislation, given the huge magnitude of implications involved. It also introduces something very new. We already have stress testing for something like 114 systemically important banks across Europe, including third country banks as well. But for financial institutions that have an enormous foothold in terms of ICT activities and rely notably on outsourced activities, there will be an imposed once a year operational resilience testing apparatus, which will be imposed under this piece of legislation and overseen by the national competent authorities. So this will look at issues like assessing the preparedness for handling ICT-related incidents, identify any weaknesses, deficiencies, gaps in terms of the digital operational resilience. And for those financial institutions that have a magnitude of ICT activities which will be defined under the regulatory technical standards, there will be a further every 3-year penetrating, as it were, testing operation required by these financial institutions. As far as the third-party ICT members, they will also be subject to their own, as it were, list of requirements vis-a-vis the outsourcing party, whether that be a bank, pension fund, or insurer. And that means pre-outsourcing due diligence. To what extent is this third-party entity reliable? Does it suffer from concentration? Is it the only third-party ICT provider? Is there a risk of no substitution should that particular third-party ICT entity collapse with huge implications going forward? Assessments of the ICT third-party concentration risks. To what extent is this particular ICT third-party so prominent across at least 6 markets that its collapse could be as important as a collapse of a major financial institution? Disaster recovery plans, if any, in terms of the third party. Governance arrangements, is there a fit and proper of senior management within this third party ICT firm that is robust, that's undertaken on an independent basis, and do they report, and what means will they be using to report on any major ICT, as it were, incidents? Now, the weak part, I think, of this particular piece of legislation, which again will come into place in 2025, the 17th of January 2025, not 2026, is the supervisory mechanism. And this foresees a sort of a mix of the ACEs, the EBA, ESMA, EIOPA, depending on the financial institution, with powers to ask for information, conduct on-site inspections, issue remedial recommendations, impose sanctions, but it has to be done in conjunction with the national competent authority of that financial institution where the financial institution has its holding entity. So the NCA powers to oversee risks flowing from financial entities which are highly dependent on third country or third party ICT providers is going to be a critical issue in terms of success going forward. Next slide, please. So we also have, as I've said already, coming up a more robust definition of what constitutes critical ICT TPPs, the number, the systematic character of the financial entities that rely on the provider, and the degree of substitutability. In other words, to what extent are these particular third-party entities capable of being substituted at short notice? Now, interestingly, this is where the third country element comes in. There will be a total ban, but I mean a total ban on EU firms who will not be authorized to provide ICT TPP services if they are not established as an entity within one of the 27 EU member states. So in other words, any third-party ICT TPP based in some other part of the world outside of the European Union will not be allowed to provide such services going forward. The extensive nature and scope of this means that there will be a scramble to find clearly ICT TPPs that can service a broad range of financial activities, even at an outsourced nature, across a number of markets in Europe. The scope obviously also covers the range of micro enterprises, but at the last moment, this was reduced to only investment firms that have assets under management of less than 1.2 billion euros, which means that essentially a lot of small to medium-sized investment firms, banks, insurers will be excluded from this particular onerous requirement to apply the full application of DORA. And in terms of other exemptions, interestingly, under the investment firms regulation, exemptions will also be provided for client orders handled of either less than 100 million euros per day of cash trades or 1 billion euros a day for derivatives. So some very, I think, extensive, helpful, constructive exemptions going forward. As I've said already, all of this, we will need to see the actual evidence on the tangible regulatory technical standards covering ICT risk management, establishing robust rules on security policies, firm governance, detection procedures. These will all have to be defined under Article 15, under Article 18, classifying ICT-related incidents and cyber threats, Article 20, incident reporting, under Article 26, the Advanced Digital Operational Resilience Testing apparatus, and third-party risk management under Article 30. All these issues will have to be provided for under regulatory technical standards going forward. Next slide, please. The other big issue, of course, is the markets in crypto assets. Now, this, again, is a game changer compared to other regions of the world where it's a very fragmented approach to regulating crypto asset providers, issuers, trading platforms. The EU has taken a very comprehensive, leaving no stone unturned type of approach, which means it covers trading platforms, custodian wallet providers, exchanges, issuers, providers, etc. The key focus in Europe was quite visibly investor protection and financial stability. So in terms of the broader approach taken by the EU, compared to other regions, everything that relates to crypto assets, trading, advice, transmitting orders, custody, crypto to crypto type exchanges will be covered under this piece of legislation. It also imposes, interestingly, a liability for crypto asset providers in terms of custody losses. Should there be a cyber attack on the digital wallets, it's the crypto asset provider that assumes that responsibility. And also there's a very robust anti-money laundering dimension built into this, in extremis. In other words, any crypto asset transfer in excess of €1,000 will be subject to increased due diligence in terms of the identification of the beneficiary and the issuer, all of which must be documented and provided as evidence to the national competent authority where that crypto asset provider or issue is based. Sadly, there's no equivalency or mutual recognition associated with this, and indeed one of the critical issues is in fact the fact that you need as a provider or issuer to have a physical presence somewhere in the EU, 27 EU member states. So we are seeing, I think, a general strategic autonomy type orthodoxy being imposed across a range of activities. In other words, let's rely more on indigenous or established subsidiaries or branch-led third country banks, insurance companies, investment firms, crypto asset exchanges, but there must be a physical legal presence to allow for these activities. Next slide, please. This piece of legislation also comes with some interestingly prudential rules. I've always said this is a bit like a mini capital requirements directive and regulation. It has things like governance arrangements, it has prudential rules, it has capital requirements, it has fit and proper assessments and due diligence to be undertaken, particularly vis-a-vis the providers. So for issuers, they will need to have and own or at least maintain at least capital funds of €350,000 or 2% of their total reserves, whichever is largest. Significant users, issuers which have yet to be defined under the regulatory technical standards, need to have at least a capitalization in excess of 1 billion or recording 500,000 transactions per day, a maintenance of capital funds of equal to at least 3% of reserve assets. So we're looking at some pretty robust pieces of capital requirements here, and providers must also have initial capital reserves, security of the IT infrastructure under the DORA arrangements, solid corporate governance structures, and suitability of management board. In other words, it's the CRR are three pieces of legislation in terms of its new revised, harmonized, fit and proper rules, which would apply equally here as well. Now, I should mention that this is a piece of legislation which, yes, helps to facilitate the creation and growth of crypto asset activities per se, with some very robust safeguards. However, it is largely focused on, let's say, medium to large size crypto asset players. It really was not designed for small startup or small to medium sized crypto asset companies. And the reason for this is the very costly and complex compliance arrangements. For instance, under the issuer piece of legislation, they have to apply for a white paper for every new admission 20 days ahead of the admission to the national regulator. And for the providers, they need to also provide a sort of prospectus for approval by the NCAs on a range of activities that they undertake, whether it be custody, brokerage, trading, or investment advice. Now, the point I'm trying to make here is that the white paper for issuers is a huge cost, anything between $4,500 and $87,000, according to the European Commission's own studies into this some 2 years ago. Ongoing compliance costs are anything up to, globally, up to 28 million US dollars for the European Union as a whole. And one-off compliance charges for providers per provider can be anything between 3.2 and 19 million US dollars. Again, I'm quoting from the compliance course as undertaken by the European Commission some 2 years ago. So quite visibly, this is really designed for the large players. The other question I would mention, not such good news, is the Basel Committee has been looking at capital charges applicable to crypto asset players, particularly banks who indulge in this. And they're looking at a proposal of something like 1,250%, 1,250% risk weight applied to long and short positions under the forthcoming Basel regime. Which is subject to consultation as we speak. Now, it has to be said that at the moment, many banks have very limited exposure to crypto assets. According to the Basel Committee, the Bank of International Settlements, something like investment banks alone limit their exposure to crypto assets of between 0.1 and 1.6% of core Tier 1 capital, but that could expand should there be relief given under the forthcoming Basel deliberations, which are nearing their end. Next slide, please, and then I think I really will have to wind down. But this is another interesting, again, game-changing issue. It relates to the creation, after years of frustrating experience with relying on national competent authorities to police increasingly complex cross-border financial transactions that had dangerous money laundering implications. Just to put this in the context, in Europe alone, according to Europol, as much as 0.7 to 1.28% of the European Union's annual GDP is, quote, detected as being involved in suspect financial activities such as money laundering connected to corruption, arms trafficking, humans trafficking, drugs dealing, tax evasion, fraud, terrorist financing, and other illicit activities which affect citizens in their daily lives, end of quote. So that puts it in context. Clearly, by 2025, we will have a new independent, standalone, high-level EU AML Authority. We haven't determined quite yet where it's going to be based, but its main purpose will be to supervise directly 40+ financial institutions of a particularly high-profile risk nature, typically financial institutions that have cross-border activities, that have had issues with the regulators at national or pan-European level in the past in terms of money laundering. And also it will include at the very least, at least one major financial institution per each 27 EU member states. So it could be a bank, it could be an insurer, it could be an investment firm going forward. With the discretion provided for this authority under the regulation, and it's a regulation, not a directive, so it will have to be applicable automatically and systematically across all of the 27 EU member states at the same time. But what it will mean is the discretion, a bit like the ECB SSM has the 114 banks, 40 plus financial institutions directly supervised and on all aspects of compliance vis-a-vis the 6-7 anti-money laundering directives up to date. Now the scope is huge. Not surprisingly, we find crypto asset providers in here, as I've already mentioned, credit institutions, banks, bureau de change, investment firms, UCITS firms, management companies of UCITS firms as well, credit providers other than banks, e-money institutions, payment service providers, life insurance undertakings and intermediaries, and as I've said already, crypto asset providers. Now, as far as third countries are concerned, there is a separate chapter in this regulation, which indeed does explicitly recognize the need to protect Europe, the European Union, and its financial stability by identifying at a very early stage those financial institutions with a prominent presence operationally across the 27 EU member states who could potentially, I say potentially, pose a risk to the financial stability in the EU. Now, this would probably consist of a memorandum of understanding, a separate one I might add, between the UK and the EU, the US and the EU, Singapore, Hong Kong, and other major financial regions and hubs across the road to ensure that the European Union has some degree of oversight, access to information about these financial institutions, their activities, transactions, as they relate to the European Union going forward. So it would be high-risk, cross-border financial institutions that will be, I think, largely focused on. The other important thing, interestingly, is and I'm just about to stop now, one last word, if I may just say, that interestingly, and somewhat controversially, I would say, the national competent authorities and the EBA will find their role significantly diminished as a result of the creation of this new EU AML authority. The entire oversight at a direct institution by institution level will be undertaken by this authority. On that note, let me hand back to you, Charlotte. Thank you.
Thank you very much for that in-depth presentation, David. We've got some great questions that I'm certainly keen to hear answer. Firstly, Martin Watkins, you mentioned CSDs and the extensive scope of DORA. Are they covered?
I'm sorry, I didn't hear the first part of the question.
CSDs, are they covered in DORA?
Yes, they are covered, but again, it depends on the definition, the magnitude of transactions. All of that has to be defined in the forthcoming regulatory technical standards. There are something like 7 of them, one of which will provide for definitions under that chapter.
Okay. Youssef Neem has said, recently the EU passed the AI Act. How do you foresee this impacting the financial services industry's adoption and continuing use of AI?
Yeah, very important question. Huge implications. I mean, this was not primarily designed, the AI Act, specifically for financial services. It's much more of a global, universal application of AI, but quite visibly, probably the one of the most important problematic areas, in my view, is that the financial institution that develops an AI application for outsourcing or delegation to third parties, intermediaries, brokers, dealers, anywhere in the financial services, as it were, ecosystem, the financial institution at the instigation of this remains responsible for its final use or misuse by the rest of the ecosystem. That's a huge implication, which should mean that many financial institutions should be very carefully undertaking due diligence of any AI application they develop in-house for use by third parties or indeed by clients for that matter, because they will remain responsible and it's a sanctionable offence if there is misuse of the AI application.
Michael Ng has asked, will there be an equivalence regime for non-EU ICT TPPs, such as those in the UK, to service EU investment firms, or is that being ruled out of scope?
Well, there's no equivalency arrangements foreseen under DORA. And indeed, as I said earlier, any non-EU third-party ICT provider, unless they have a judicial presence or they have a physical presence in one of the EU member states, either as a local agent or a subsidiary or a branch, they will not be able to provide, continue to provide services of that nature particularly to the major financial institutions, the global systemically important banks and systemically important investment firms as well. So no, that's not foreseen. Clearly, it's a bit like the MICA issue as well. You need to have a presence in one of the 27 EU member states. Now that, of course, could evolve, but right now there is a very clear orthodoxy running through the EU in terms of strategic autonomy, the recognition that Europe has to undertake a much more assertive role in managing, regulating its own financial institutions. This is not just financial institutions, it covers a range of areas from telecoms to health, drugs, pharmaceutical products, etc. So it's a general move towards strategic autonomy at the EU level.
Peter Hall has said major US law firms hold written confidential British ministerial assurances that money laundering conducted by US lawyers through British offshore centres will be immune from British AML processes for the purposes of conversion into euros. Are there assurances that this will be voided by EU 2025 oversight of British AML supervision?
Premature. This separate chapter on third country high risk financial institutions in third countries has yet to be further developed and undertaken by the ASAs, and all of these issues will be part of that part of the regulatory technical standards going forward. But presumably, predictably, it could end up being a memorandum of understanding between various non-EU jurisdictions with regards to unfettered access by EU regulators, notably by this new EU AML Authority, to conduct, for instance, on-site inspections. Now, will this be acceptable? Will this materialize? It's far too early to determine at this stage.
Ravi has asked if there's any update on Russian sanctions.
And a week doesn't go by without the EU announcing yet further sanctions on financial institutions, third-party institutions that have indelible contacts and transactions with Russian industry or financial services, or individual Russian personalities with activities running through the EU, very similar to the US. So yes, there's been a general, and I have to say, a massively consensual approach at the Council, notably by the Council, which represents the Member States, in terms of pursuing sanctions against the Federation of Russia by closing down major sources of funding to Russia. There's the only area that has escaped this is certain payment systems, because they could have huge implications for financial institutions and other industries in mainland Europe. But there are very few exceptions, and I think we've just seen recently further reinforcing of these sanctions against Russia, against the Russian Federation, because of the geopolitical events that have occurred in the last year.
And Ashley Winton has asked if MiCA has any extraterritorial effects. Will it affect businesses in the UK?
Sorry, I didn't hear the first part. Will what?
MiCA have any extraterritorial effects? So will it affect businesses in the UK?
Well, yes, by virtue that the United Kingdom is now no longer a member of the EU, any MiCA provider issuer needs again to register its services in one of the 27 EU member states, which would then allow the issuer provider or indeed exchange to have access to the other 27 EU member states. Now that potentially could be via an existing bank or financial institution with which it has a legal agreement or has a partnership, not just a memorandum of understanding, but there is a need for, and this was also one of the almost key concerns of the ECB earlier this year, when it warned third country banks and crypto asset providers and issuers that they needed to have a physical presence and not just a brass plate or a shadow sort of type activity, which allowed them to transact business as usual. No, there is need for a physical presence. There is need for licensing, authorization, and of course due diligence as foreseen under MiCA. So this is again a general shift towards ensuring consistency in terms of the crypto asset players and actors that operate across the 27 EU member states.
Okay, one quick last question from me. With regard to the new AML Authority, what are the implications, if any, for the UK being a non-EU member state?
Yeah, I guess I said earlier, this is a separate chapter under the EU AML Authority regulation. It comes into place 2025. It will start operationally 2026. It will probably be beyond 2026 when we see some movement by this authority to at least open up a dialogue, perhaps separately to the memorandum of understanding that I just mentioned earlier in relation to the UK exit from the EU. That's a separate, as it were, activity. But this is a separate memorandum of understanding between the new authority, AML Authority, and the UK, US, and other financial hubs across the world to allow for some degree of access by the authority, on-site inspections potentially, but also making sure that the financial institutions have robust risk due diligence assessments undertaken vis-a-vis those activities that are conducted in the EU. So yes, there are going to be some huge implications. I mean, obviously the wording in the chapter is not terribly flattering. You know, identification of high risk financial institutions, that needs to be clearly defined. We're all hoping praying that this would be a collegial approach now that we've signed the Memorandum of Understanding in relation to the financial services, that we will have a similar piece of goodwill on both sides to be able to work out a reasonable arrangement for exchange of information between both parties, the EU, the UK, the US, Singapore, Hong Kong, and other major financial hubs going forward. But be under no illusion, this is going to change radically the way a compliance oversight has been conducted up to now by the EPA and by national competent authorities. Visibly, those two particular aspects are now going to be shifted massively into the hands of the new EU AML Authority, which will have massive discretionary powers that didn't exist before.
Okay. Well, thank you very much, David. It was lovely to catch up and pick your brains once again. As usual, you've provided a thorough and insightful presentation. And also, I must thank our wonderful sponsors for making these webinars possible, and to our audience for your time and worthwhile contributions today. Don't forget to check out the forthcoming events page on our website. We've got lots more diverse content coming up for you, including what we should teach our children about money and economic lessons from COVID, all happening next week. Thank you very much, everyone. Goodbye.